Hello everyone, this is Andrew with Spark Finance, and I want to talk about something that has been occurring recently, and I'm wondering if people are realizing the real historical significance of what is going on here. So we have these companies that are kind of online brokerages, but they operate off of mobile phones like Robinhood and Webull. So they came into the marketplace, they were promoted very heavily through affiliate links and on social media, and they even give people a stock worth a couple bucks when they sign up. So they grew really fast. Now the difference with these companies compared to what is already out there is that they also offered zero upfront cost to trade stocks. A lot of these other brokerages, the online discount ones, they had stock fees when you were making a purchase. You would have to pay a certain commission to them. Now, people, especially of younger generations, they flock to these new platforms on their mobile phones. And this got me thinking. When was the last time there was a major marketplace disruption with the stock trading and brokerage houses? I mean, did this ever occur before in history? That brings me to May Day, May 1st, 1975. This is a really important day here that kind of changed the world of the time then, and I want to see how it relates to today, right? So the New York Stock Exchange back in 1975, they came out with this new policy that they would remove all of the minimum fee on investing in stocks. So there was like a set fee structure, which I could show an example of what it was in the past. And in 1975, they kind of deregulated that and eliminated it. Now, prior to 1975, it was very expensive to trade stocks, and usually only people that were already wealthy were involved in the marketplace. One of the big things that you had to pay was a percentage of your total amount of stock that you want to buy on the total value of your purchase, right? So let's say you put $3,000 into a company's stock that you wanted to buy. So you would have to pay a $19 upfront cost, as well as a 0.5% fee that amounted to another $15. So in total, that's $34 that you had to pay them to make this trade. And keep in mind, that is pre-1970 money when money was actually worth something, right? It's a lot different now with all the inflation over time. Then May Day comes along, and brokers are now allowed to charge varying commission rates. They don't have to go by this previous set fee structure. This is huge. So, for the previous 180 years, there was no competition in the marketplace for doing brokerage type work, buying and selling stocks, trading options, doing all of that kind of stuff. When we see competition in a marketplace, prices go down, innovation and quality go up. That's what we want to see. We want to see competition in the marketplace. So after this change by the exchanges, then Charles Schwab, like a boss, comes in, and Charles Schwab was one of the first online discount brokers, and they came in and basically eliminated all of the hindrance to people moving into the marketplace and made it so that just anybody can do it. On May 1st, 1975, which was later turned into May Day, they became the first broker to basically have this ability for any individual to just go and make these trades at a discounted cost. So several other companies after Charles Schwab came in also did that. And then now, next thing you know, your average Joe can go and purchase shares of his favorite companies. He can go invest in the marketplace. He gets started investing a lot earlier than he would have if he had to wait until he had an exorbitant amount of wealth to be able to do it. So when you have a large amount of these people coming in that were never in the marketplace before using these new discount brokerages, the average households and families were now getting exposure to the stock market. And their investing careers started a lot earlier because of this. And this is a net positive, right? Because we know that compounding works better the earliest you start it. So if you're looking at compound interest, if you start 20 years ago, it's a lot better than if you start today. Now, check out a chart of the S&P 500 from that time period around 1975, May Day, May 1st. And then this is when the discount brokerage revolution came out. And then look at the stock price of the S&P 500 index as it goes through to the modern era, right? Of course, not all of these gains are just from this. But you think about it, I mean, there's a lot of factors, right? But what happens when you increase accessibility to the product and at the same time greatly increase demand? And in this case, the product is equities or stocks, right? So when you have all of that demand and accessibility come in, a lot more people are going into the market, driving up prices. And I think that may be happening now with what's going on with the Robinhood, Webull, kind of the mobile apps that are out there. Now, as time went on, these discount brokers, they built full-fledged websites that people could access and purchase securities online from the comfort of their home, right? So they could be sitting in their office at home and just purchase stock right there. They don't have to call up a broker and talk to them. It made it even cheaper and even easier. Those are two key themes right there. So going into the years, the 2000 years, stock trades became as cheap as $5 to $15, no matter the size of the purchase. So it was easily accessible for anyone, right? Now, hold on a minute. Why are we talking about Charles Schwab and this events in the past, right? What does this have to do with Robinhood and what can happen in the future? Well, I'm getting to that, right? So think of the new revolutionary companies. We have Robinhood, Webull, M1 Finance, Acorns. All these companies came out recently. And what have they done to start a revolution? Similar to 1975, when the discount brokers obliterated the previous cost of trading, these new companies are now making trades possible with no upfront cost. There's no cost at all. They capitalized on a new platform, which were mobile phones, where the competitors were really lagging or had very clunky interfaces, right? These companies were more technology companies and knew how to make a user interface or UI. They made investing fun and entertaining. Most importantly, similar to 1975, they brought in people that had never traded equities or stocks before, and these people were now regularly buying and selling stocks on Robinhood on their phone. This is ushering in a new era of investors. Also, think of how this positions these companies, these new innovative companies, for the future. When are they going to have their IPOs, I wonder? So other companies have succeeded by kind of going after the younger audience with the hope that as they mature and become adults, they will be hardcore fans of their products because they used that as a kid. Think of Apple and Disney and McDonald's. I mean, there's a lot of companies that done this where once you get hooked on that brand, you kind of stay with it for life. Now, all these other companies, all these other brokerages are trying to race to catch up to these fast-moving startup companies. October 1st, 2019, Charles Schwab announced that they were removing all costs to their trading so you can buy and sell stocks at a zero cost. Now, after they did that, all the other big discount brokerages also did that. But once again, they're playing catch up to these mobile phone apps. Looking at the brokers, the major brokers today by websites visits, you can see Fidelity is number 1, then you have TDAmeritrade, and then you have Robinhood in number 3, the 3 spot. So Robinhood in mid-2020 had 4.3 million trades per day. TDAmeritrade had 3.8 million, Charles Schwab had 1.8 million, and eTrade had 1.1 million. Robinhood now has 13 million accounts. So never mind, with Robinhood, it doesn't matter that it's rated, I think it's 9th in the top online brokerage firms. It doesn't matter that it's rated all the way at the back end of the spectrum there. Younger consumers don't care. All they care about is that they get a free stock worth a few bucks when they sign up by using their friend or influencer's referral code, and then they can trade stocks quickly and easily for no upfront trading fee. They get a simple to use interface that is fun and easy, and they can be off to the races. They can just go and experience it and learn. In the case of Robinhood, though, on the downside, never mind that the company is being investigated by the SEC for misleading investors. They also failed to protect users' assets from hacks when people had money siphoned off from their accounts and they didn't have a phone number to call even. They encourage inexperienced investors into risky trades. They're also being looked at for that. They're loaning out money in the accounts to offer interest on the accounts, right? But it's not backed by FDIC insurance as if it was a bank or another brokerage. It's actually backed by a different private insurance, which we don't know if it's as good or not. And they also do not offer any of the same kind of tools and different things you can utilize as other brokerages to make better trades. And the idea that also that it sells out your order flow data to high frequency traders. So remember, if you're making purchases on Robinhood, use limit orders, because otherwise they will make money on the spread, because you say I want it at $20 and they sell it to you at $20.05 and they make that little bit of extra difference or something like that if you're putting a marketplace order in. So I want to see if this is a major turning point for the marketplace in buying and selling stocks, just as May Day was in 1975. Maybe there's going to be a new name for this kind of change of retail investors and bringing in young investors in particular into this new market. This can be a very positive thing for people to learn about investing at a much younger age. I mean, there's some negatives, but there's also a lot of positives. So we're also seeing people now trading based on where they think millennial money will flow into the market, right? Novice investors are also making a lot of mistakes as they're basically learning. People bought the stock ticker symbol ZOOM when the company they thought they were buying was this ticker ZM for Zoom video communications, and they actually ended up trying to take that one off the market because it was confusing people so much. Then people bought Signal Advance, which was a publicly traded company, because Elon Musk made a tweet, put some buzz out there about using Signal. But the thing that it was supposed to be was actually Signal, the messenger service instead, which is not publicly traded. So once again, people made mistakes. So a lot of these people, they're also making mistakes in purchasing the wrong options on the wrong stocks. And a lot of people are going into margins and doing some things that are kind of crazy here. And they're going to learn over time what is right and what is wrong for them, right? So there's going to be a giant shakeout from these people that it's easy to make money in a bull market. A real investor needs to be able to survive a bear market. And after the next shakeout, a lot of these people that are left, that is going to create an entire cohort of people that will continue investing for the rest of their lives. They will be in the market and they will understand it better. They will have survived a big downturn and they will be solidified in that position now. So this is a lot of demand that is going to go into equities, and this should help increase equities to go up in value. In today's world, 52% of households own shares of stock, whether it is individually or through retirement plans at your company or an individual retirement plan. So just looking at some other notes, I want to say here, I guess some other things just looking at this. You don't need to use Robinhood or Webull for your go-to brokerage app or for your way to trade stocks, right? I'll put a list in the description of some of the highest ranked companies to do these type of endeavors, right? So you can pick and choose based on what your needs are. So if you're going to just kind of invest and you're just starting out, you've never traded stocks before, and you just kind of want to mess around with it, maybe learn a little bit, and you're doing, say, $5,000 or less, not doing like a crazy amount of money, then you can use something like the Robinhood app. But if you're more serious and you really want to get into investing in stocks and potentially in bonds or options or other different avenues, then use one of these brokerages that offer a lot more features as well as having a safer and secure environment compared to these mobile apps. So another thing I would like to mention, remember eTrade was the one out of all those brokerages that in 2008, they almost went bankrupt. So just wanted to throw that out there, maybe stay away from that one. But I think the fact that you're seeing all these companies racing to basically do what they had done in 1975 when these new companies came out, and now you have the old companies trying to match what they're doing, it's pretty crazy. That's innovation right there, right? And you're seeing people, what they're doing as kids, trying to get people early so that they get them as adults. And then finally, like companies like Goldman Sachs. Goldman Sachs has been a wealth management company for 150 years, right? They're completely changing their business model now. They're going into like all of these credit card programs with different companies, with the car companies and with Apple and everything. And they're trying to chase these fintech companies that are on the bleeding edge. And the fact that you're seeing this old company completely changing their business model to go after retail investors, they are scared that they are going to lose the next generation of investors. And the next generation of investors is coming into this marketplace, and they're learning things that in previous generations, people did not learn for years and years until they were older and they had a lot more experience and they heard about it in their work environment or in programs. Now people are able to learn all this information earlier, and hopefully this is making the world a better place. Thank you for watching Spark Finance. I love talking about these different innovative technologies that are coming out here. If you want to hear more of them that are coming out in the future, just stay tuned to the channel because I'll be making videos on all of them. Thanks for watching.